Howdy, everybody. Welcome to the Liberty Call. I'm Raymond Dahlman, your humble host here at the Liberty Call. And we are trapped here in snowy Colorado. We have not seen the sun in days, and the snow is getting up to my waist at this point. So, anyways, I spent yesterday afternoon clearing a driveway, and that was fun. Actually, I did it before the video, but yeah, it was not a good time. So, anyways, hope you're having a better day out there. It is the end of the week, which is nice. It is Friday, and we're ready for the weekend. Me and my main man, Jake, back here. Hey, Jake, say hi. He's like, whatever. All right. Well, before we jump into the markets and the news, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. Hit it 3 times for good luck today. All right. Well, let's hop into the markets. Dow Jones up 0.59%, 259 points, closed at 43,988, just a hair under 44,000. S&P 500 up 0.39%, 23 points, closed at 59.96. NASDAQ up 0.11%. It was in the red when I came down to my desk this morning. 21 points it was up, closed at 19,290. The VIX down another 1.64% today. It's at 1495. Canada down 0.35, Brazil down 1.37%, and Mexico down 0.77. Let's go to Europe. In Germany, they were down 0.81%. The UK down 0.84%. France down 1.17%. The Netherlands down 0.5%. Spain up 0.49%. Italy down 0.48%. Switzerland down 0.94%. And Portugal up 0.61%. Again, this is like 2 days this week where the countries in the Iberian Peninsula, Portugal and Spain, were opposite. I think it was the other day, all of Europe was up and they were down. So strange. Russian exchanges were both green today. The MOEX up 1.65, RTSI up 1.9%, and the overnights, the Nikkei in Japan was up 0.19%. Australia up 0.84. New Zealand, when it closed on the 7th, was up 1.09. And the Chinese markets, yesterday they were way up. Today they're down. Shanghai down 0.53%. The Shenzhen Component down 0.66%. China A50 down 1 1/3. DJ Shanghai down 0.5%. Hang Seng down 1.07%. And the Taiwan weighted, when it last closed on the 7th, it was up 0.82%. All right. So those are the markets for today. Let's hop into or bring up my charts. And we can look and see how the markets did for the week. All right, we'll start out with the Dow. All righty, the 4th was the Monday, so let's start out with the last candlestick on Friday. All right, so it looks like the markets are, the Dow is going to finish the week up about 4.96%. The S&P 500, 4.59%. The NASDAQ, going to be up about 5.69%. And the Dow Utilities, here we go, up about 1 3/4. And the Dow Transports, man, everything's up this week, up 6.01%. So really good, really good week. Excuse me. Really good week for the markets, and I think a lot of that had to do with the election. And but let's zoom out and take a look at the year, so we can see here, starting out with the Dow, fairly flat to begin the year, coming off that uptrend late last year. Had a slight uptrend through the middle part of the year, and then a more pronounced uptrend here in the fall. But we did, as I mentioned last week, broke the trends on all the major indexes as of last week. And let's see here. But we've had this massive jump up, so we'll see if it's going to come back in line with this trend, or what's happening here. Same thing with the S&P 500. That uptrend lasted a little longer into the first third of the year. 2 weeks down, another several months on an uptrend, another few weeks down, and then the current uptrend we're in. We broke that trend last week. What day was that? Wednesday or Thursday. And then broke back above the trend line here after the election, so on Wednesday. And again, the same very similar chart for the NASDAQ. NASDAQ and the S&P look more similar than the NASDAQ and the Dow. All right. Well, those are the markets. So let me put everything back the way it was. So when I come back to work Monday, everything doesn't look weird. All right, let's hop into the data that came out this week. Starting out with initial jobless claims, they came in at 221,000, below the 223 forecast. Previous number was 218. Continuing jobless claims came in at 1.892 million. Forecast was 1.88. Previous number was 1.853. U.S. all car sales came in at 3.05 million. Previous number was 2.98. So a little bit of an uptick here the last couple of months. All U.S. truck sales came in at 12.99 million, above the previous number of 12.78. Fairly stable here on truck sales, the better part of the last year plus. Factory orders month over month contracted at 0.5%. Forecast was a 0.4 contraction. Previous number was a 0.8 contraction. And the Fed, they had their interest rate decision come out this week. They reduced rates by 0.25%. So we can see here we were held steady at 5.5 for the better part of a year. Dropped down 50 basis points or 0.5% at the meeting mid-September. And then the meeting this week, they dropped it 0.25%. So I have a video at the end of the broadcast that we're going to cover. Goes more into that. So I'll leave that for that. U.S. non-farm productivity quarter over quarter grew at 2.2%. Forecast was 2.6. Previous was 2.1. And unit labor cost quarter over quarter grew at 1.9%. Forecast 1.1. Previous was 2.4. And the last bit of data for the week, U.S. Michigan Consumer Sentiment Survey came in at 73. Forecast was 71. Previous number was 70.5. All right, so that's all the news or all the data for the week. So let's go ahead and hop into our market recap. S&P 500 Dow rise after briefly hitting unprecedented levels. All righty, let's get to my notes. Here we are. The Dow and the S&P 500 hit record highs on Friday, driven by optimism around a potential second Trump administration and its anticipated pro-growth economic policies and pro-inflation. All major U.S. stock indices, including the NASDAQ, posted weekly gains, with the NASDAQ outperforming at a 5.5 or 5.6% increase through Thursday. Strategists from Bank of America, led by Michael Harnett, suggest the post-election period through Inauguration Day offers a risk-on opportunity for stocks, especially for sectors like financials, REITs, and small-cap stocks, which may benefit from anticipated Trump policies. Consumer sentiment surged in November, with the University of Michigan's index rising to 73 from 70.5, the highest level since April, reflecting renewed confidence in personal finances and economic prospects. Meanwhile, the Federal Reserve proceeded with another 25 basis point rate cut on Thursday, lowering its benchmark rate to a range of 4.5 to 4.75. Fed Chairman Jerome Powell emphasized the recent positive economic data hadn't altered the Fed's course, suggesting additional rate cuts remain likely. According to the CME's FedWatch traders estimate a 76.1% chance of another 25 basis point cut next month in December. In individual stocks, Tesla's market value topped $1 trillion as shares rose over 7%. Trump Media and Technology Group jumped 13% after President-elect Donald Trump reiterated he would retain his stock in the company. On the other hand, Airbnb declined by over 8% following mixed quarterly results that fell short of analysts' expectations. Overall, the markets are seeing strong gains underpinned by bullish sentiment and potential favorable policy directions. However, investor attention remains on the Fed's future rate path and on the incoming Trump administration's economic policies. Well, they certainly could be worse than the last people. And I mean, the 3 years before 2020 were actually fairly smooth, 17, 18, and 19. Yes, there were certainly warts on that pig as far as the economy. The banking system was having some wobblings in the fall of 2019, which I was pointing out to clients. The yield curve was starting to invert. And most of us thought, well, I would imagine most investment advisors who pay attention to what's going on in the economy, as opposed to just listening to CNN and all the idiots there. But anyways, what happened? All right, there we go. All righty, well, let's get to our next article. This comes from Zero Hedge, Trump Presidency, quick thoughts on the market impact. The potential effects of a Trump presidency on the U.S. stock and bond markets present a mix of opportunities and challenges. Initially, why does this keep disappearing? That's weird. Initially, where was I? Trump's policies, such as the preservation of the 2017 Tax Cuts and Jobs Act and possible additional corporate tax cuts, could boost certain sectors. Consumer discretionary and tech companies stand to benefit, along with financials that could gain from deregulation. With seasonal trends and corporate buybacks, stocks may have bullish momentum through the end of the year. However, risk exists. Protectionist policies and tariffs on China could increase costs, disrupt supply chains, and dampen corporate profitability, while cuts to government spending might slow economic growth, offsetting tax cut benefits. I don't think slowing down government spending is going to hurt us in any sizable way. For bonds, Trump policies could pressure yields. The Fed's rate cut amid recent inflation data might not ease bond market concerns about Trump's focus on deficit finance spending for infrastructure and defense, which could elevate inflation and keep interest rates high. As a result, bond prices may face headwinds from rising yields. Additionally, the high correlation between economic growth, inflation, and interest rates could mean continued caution in the bond market if Trump's policies foster sustained growth and wage increases. Despite some inflationary pressures, high federal debt and fiscal deficits may limit growth and keep long-term interest rates lower. Debt service diverts tax revenue from productive investments, potentially weakening economic growth. Structural issues like demographic shifts, employment changes, and deflationary productivity gains further complicate the outlook, challenging any president's ability to fully address these factors. Overall, investors should stay cautious. Trump's pro-growth policies may initially rally stocks, but economic fundamentals, possible tariff challenges, and structural debt issues call for a diversified investment approach. The next presidency promises significant market volatility and mixed outcomes for various asset classes. Yeah, it's, while the market has been in this, exuberance the last 2 or 3 days, nothing has changed. We still have all the same problems. We still have all that debt. We still have all these, government jobs that are basically just daycare for people, very expensive daycare, if I might add. And we really should, just be slashing and burning at the federal level, and moving these jobs back to the states where they belong. The states can more easily, and the counties can more easily address problems locally, because it doesn't take, having conferences and, investigative studies to see if we should do something. They just do it. You get together, you have your town council or whatever, and you say, all right, well, here's our problem right now. We need to fix it. All right, let's vote on it. All right, nays, yays, bam, done. Anyways. All right, I got one last thing to share with you here. This is 3 tough questions for the Fed at Thursday's FOMC presser. This comes to us from Ryan McMacken. So we're going to take a couple minutes and listen to Mr. McMacken speak, and then we'll get to the weekend. So let's go ahead and dive in.
The Fed's FOMC committee wrapped up their November meeting, and they held a press conference today with Jerome Powell. And Powell released, of course, their press release. And what the FOMC has decided to do is to lower the federal funds rate by 25 basis points. This is a Fed rate cut. This was predicted, for the most part, by the markets. This was expected. No surprises there. Ever since the Fed cut the target rate by 50 basis points back in September, it's been expected that they were most likely going to do another cut. And they really hinted at this for quite a while. It would have been more of a surprise if they hadn't done any cuts at all. But what does this tell us? Okay, so they cut the federal funds rate again. This suggests to us that obviously the economy is not red hot. If it were red hot, they'd be very worried about additional and fast increases in the price inflation rate, and they would have either held the rate steady or perhaps increased it. I think what the Fed thinks they can do is they can get away with cutting the Fed funds rate again and maybe just keep their fingers crossed and hope that price inflation won't come back quickly. It seems that markets, however, are not really believing them, as we're seeing bond rates, bond yields start to go back up. We'll get to that in 1 second. Just overall, generally, when the Fed is cutting rates, that means it fears that there's a recession approaching, and they keep cutting. This happens pretty much every single economic cycle. The Fed always says that there's no inflation headed or there's no recession headed our way, that we're going to cut rates, though, just to keep job growth high, and everything will be fine. We'll have a soft landing. That doesn't happen. If the Fed's cutting rates, it's a pretty Loctite case that you can expect a recession on the way, no matter how much the Fed denies it. The Fed, of course, denied right up until the end that there was no recession on the way in 2008, even though the U.S. was already in recession in late 2007. So the Fed seeing, right, they looked at October's jobs numbers. They saw that private sector job growth was actually negative, even if overall job growth, buoyed by government jobs, was slightly positive at 12,000. Now that's probably even going to be adjusted downward with the next report. We shall see. Now, of course, the Fed's claiming, that's due to the hurricane and some strikes and some other issues, right? Just like they said price inflation was due to Putin's price hike and things like that, or that inflation is transitory. The Fed has no special insight into these things. They're certainly hoping that job growth continues again with the November report, but they can't be sure. They look around. They're seeing, obviously, that a variety of economic indicators are looking not great, in spite of the fact that they cut the rates back in September. But what I want to talk about in this video, though, are three good questions that were asked at the FOMC press conference today. Often, the press is always there, and they ask a lot of real basic, boring questions that are not in the slightest bit going to annoy Jerome Powell. However, there were some pretty decent questions asked today, and I wanted to look at them. One of the questions, and this had to be asked twice, a couple of different reporters went around this issue because Powell basically tried to avoid it the first time. But they asked, if the economy is so great, because of course in the press release and in his remarks, Powell talks about, the economy is solid, it's expanding rapidly, things are fine, even if things have come more into balance, as they put it. But the question is, if the economy is so great, why do so many people vote for Trump? I think the narrative, of course, is that a lot of people are voting for Trump because they see the price inflation as a real problem. And this was the first time I saw the Fed have to admit that inflation is a problem beyond just whatever the short-term number is, right? Because when the Fed talks about inflation, price inflation, they're saying, right, the core CPI was this, it was that. They're only ever talking about the most recent month-to-month number in most cases. Or sometimes, I guess, they're talking about the 12-month number, the year over year. However, it's always just that most recent reading. They're never really talking about the overall increases over a period of 3 or 4 years that has taken place. He was forced to acknowledge that basically with this question, right? If the economy is so great, why do so many people vote for Trump? And Powell had to basically say, yes, even though we have made great progress on making price inflation ease and getting that under control, we're getting back to our 2% goal, et cetera, et cetera. He had to admit that cumulative inflation has been significant for a lot of people, and that real job gains basically have not been there for a long time. He's saying, we're back to some real wage gains now that we've gotten inflation under control for now, but people are still hurting from all of that cumulative price growth over that time. And he also admitted that those prices just don't go back down, that once you get inflation, it's there forever, at least as long as you've got the Fed around, because the Fed is not going to let any deflation happen. And so people are suffering because they saw huge price increases over a cumulative period after, say, about early 2022, far beyond the 2% goal, which of course is itself produces cumulative price inflation. But he had to...
All right, we'll stop it there. He's a handsome man, bald, nice beard, excellent knowledge. So, all right. It is linked in the show notes. It is the last hyperlink in the show notes. So if you want to go and watch the full, I think it's 12 minutes, 12 seconds, you're welcome to do so. Ryan's a great guy. And him and the folks over at the Mises Institute are all very brilliant people. So I would bookmark that site if I was you. So anyways, all right. Well, that's everything that I had to talk about for today. Hopefully we don't freeze to death here in our igloos. So if I do survive the weekend and you want to reach out to me for some financial planning, please go to there it is, DSAFinancialGroup.com. All your financial planning needs can be addressed right there. So give me a buzz. I'd be happy to help get you back on track, or even take you to the depot and get you on the track in the first place. All right. Well, hope everyone has a fantastical weekend, and I'll watch some college football. And what else am I doing this weekend? Probably nothing other than shoveling snow. So hope you have a great day or a great weekend, and I'll talk to you next time. Adios.